Good morning and welcome to managerial financial accounting for the fall 2022 semester. Today is November 15th, and we are going to be starting chapter 12 today. So we finished chapter 11 last class, so you know that means the problem is due tonight. There is an extra credit problem, and I explained last week there were really two problems I wanted you to do. One where bonds were issued at a premium and the other issued at a discount, but I didn't want to have two required problems. So I do encourage you to still do both of those so you have the practice, and one of those, the second one is just counting as extra credit. And of course, since we're starting chapter 12 today, the chapter 12 pre-quiz should be submitted for grading by the end of the day today as well. As always, you need to score a 60% or higher to get full credit on that. So chapter 11 is the final chapter. There are only two chapters on our exam 4. And so I have a review session scheduled for tomorrow morning. Obviously, this is optional. If you are able to attend, please sign up in Starfish, and then the review session will be held on Zoom tomorrow morning from 9:30 to 10:30. I don't know at this point if anyone is signed up for that. If nobody is there, obviously there will not be a review session, but if there is a review session, if anyone is there, I will record it and post that recording to YouTube and put the link in Brightspace, just as I've done for the first 3 exams. And so the exam should be completed before you leave for the Thanksgiving recess. You know that there are no classes next week at all. So the exam is officially due on Sunday, the 20th. And along with that exam, of course, part 4 of the annual report project. Notice that there are companies that are required for you to use for each one of those 2 parts, Starbucks for chapter 10 and Nike for chapter 11. So for this project, you will not be using the company that you chose. You'll use the companies that are specified in those problems. Any questions about any of that? So you know what's coming up, you know what's required of you. Everybody's good. Okay. First thing I want to talk about then today is the exam, so that you are prepared. So as always, there is a practice set that is not graded. It is there for you to make sure that you are comfortable with some of the concepts and calculations that are on the exam. I would encourage you to use the practice set. That is also what I would expect us to be going over tomorrow morning in that review session, unless somebody asks for coverage of something else. As you know, there are only 2 chapters. The 2 liability related chapters are what's on this exam. This exam then is about 50-50 split in terms of the points from each of those 2 chapters. And you can see in the practice set here, there are 12 exercises, 6 from chapter 10 related to other liabilities, current liabilities, and really all liabilities other than corporate bonds. And then chapter 11 is specifically about corporate bonds. So that's the practice set. Again, I would anticipate that we go over that tomorrow in that review session. And then the exam. So as with the first 2 exams, there is a time limit of 3 hours unless you have accommodations in place. And you can take it at any time. I suggested that I really would recommend that you take it probably before you think of yourself as being gone for Thanksgiving recess. You can see that there are only 17 exercises, questions on this exam. As always, there is a mix of multiple choice. Most of the multiple choice, I would anticipate that you can read the question and just choose the correct answer. The exercises then are take additional work. That means that they're also worth additional points. All right, so I would remind you that each one of the problems or exercises, questions on the exam, you can tell which chapter it came from. You are welcome and encouraged to use your resources. You just need, it needs to be your own work, but you are expected that you would use your book. Remember, you do need to open the book before you start the exam. And as always, if you run into any technical issues with the exam, you need to let me know right away. Please do not wait until after the Thanksgiving recess to tell me, oh, by the way, I tried to take that exam and something went wrong. I need to know right away. Most of the time I can just fix it for you. So we've got a mix of exercises and multiple choice questions. Some of the exercises, of course, are going to take some calculations. And I'm just jumping around here to see what other kinds of questions we might have. So you're going to have questions related to notes payable, bonds payable, other, payroll. We spent a lot of time talking about payroll related issues, so you can expect to see questions about that. We went through the entire life cycle of a bond from issuance at a premium, discount, or at par, the payment of interest payments on a regular basis, and then the redemption of those bonds at the end of their life cycle. We talked about callable bonds, and one thing we did not talk about was convertible bonds, but we'll talk about that briefly, at least in chapter 12 on stockholders' equity. So you should have read about convertible bonds in your textbook. So anything you want to talk about, any questions from any of those, either of those two chapters that are on the exam? It's a bit shorter exam in that there are only 17 questions, but it is worth the same total credit toward your final grade. So exams are half of your final grade. There are 5 exams, so that means each exam is worth 10% of your final grade. This exam is worth 10%, same as all the other exams, even though it's fewer questions and only 2 chapters. So anything you want to talk about related to chapters 10 or 11 for the exam? So I would suggest that you can take that exam whenever you are ready, once you've completed the chapter 11 problems that are due today. You're welcome to take the exam today, tomorrow, Thursday, whatever day. Just, I really would recommend that you don't wait and take it, plan to take it, say, Sunday, when you might be off campus, home for the week off. Doesn't seem like a good plan to me. All right, so if there aren't any questions, nothing you want to talk about, we are going to start chapter 12 today. We will cover chapter 12 this week, but the problem isn't due until we return from the Thanksgiving recess. And of course, the chapter 12 content is not on this weekend's exam. And once again, I should have put exercise 1 down at the bottom, but I did not do that. So when we get to the exercises in just a little bit here, we'll be starting with the second exercise in the set. And on Thursday, when we finish up the chapter, that first exercise in the set will be the last one that we do. So turning to chapter 12. In this chapter, we are really finishing up our coverage of the balance sheet. And so starting in chapter 6, when we talked about inventory, each chapter since then, we've been taking a look at something on the balance sheet. So we looked at inventory, we looked at cash and receivables and We looked at property, plant, and equipment. We talked about intangible assets and natural resources. The last two chapters, we've been looking at the liability section of the balance sheet. And now today, we are looking at that final section of the balance sheet on stockholders' equity. So you can see the title of this chapter is Organization, Stock Transactions and Dividends. But again, really the focus is on that equity section of the balance sheet. That up to this point, we've had two accounts that appear that we've known about since chapter 1. We have two accounts that are stockholders' equity. Those were common stock and retained earnings. In this chapter, we're going to see some additional accounts and talk about the related transactions, stock transactions, dividends, and so on. So we have a series of learning objectives for this chapter. We're really going to be talking about how a company issues stock, how we record it, different related transactions for stock. We're going to talk about a different class of stock altogether, and that is known as preferred stock. And we'll talk about what happens when a company repurchases some of their own stock. That's known as treasury stock. We'll be talking about dividends, which is one way that investors make money by investing in a company. We'll be talking about dividend policy, how we account for dividends. And so really the whole host of transactions that could be related to the stock of a company. We'll also be looking at the stockholders' equity statement, which is the second financial statement that we prepare in order. So income statement, then the statement of stockholders' equity, then the balance sheet. And our next chapter that we'll be covering the week after Thanksgiving recess is the cash flow statement, which is the fourth and final of the 4 financial statements that all publicly traded companies are required to prepare and have audited and share with the public on an annual basis. And so the first learning objective isn't really what I think of as the doing of accounting. It's more conceptual, more understanding the background, learning some terminology. So I'm going to skip through this pretty quickly. But as always, you are responsible for reading what's in the textbook on your own. And obviously, if you have questions about anything you read, even if we didn't talk about it specifically in class, or maybe especially if we didn't talk about it in class, you should make sure you ask those questions. I don't like to spend a lot of our class time telling you what you already should have read in the book or will read in the book on your own. So we talked about at the very beginning of the semester, the 3 basic types of business organization in the United States. We know that we are focused on the corporate form of organization in this class. So corporations make up a relatively small number of the total businesses in the United States, less than 20%, but they account for about 80% of the revenues of companies, of businesses. Some of the advantages of the corporate form of organization is there, and I mentioned this in our last chapter when we talked about corporate bonds. One of the advantages of the corporate form of organization is they have access to the capital markets. And so chapter 11 was focused strictly on the borrowing that corporations use to fund their operations. And this chapter is really focused on the investing, bringing in new owners. So what makes corporations different than other types of business organization is that they have stock that can be sold. If they're publicly traded, that means those shares are sold on the open market or they're publicly traded. And that is a way that companies, corporations can raise financial capital, that they can access investor dollars to use to run their business. So that's one of the advantages, but it also is one of the disadvantages because there's a separation between the ownership of the company and the control of the company. And we've talked about that a little bit in an earlier chapter as well, what I referred to as the principal agent problem, that the incentives of the owners may not be completely aligned with the incentives of the managers, because each one is in it to enrich themselves. Excuse me. And so in order to be publicly traded, that has to be approved by the SEC. You have to have formal authorization to sell your shares to the investing public. Some companies are many companies are corporations, but they are not publicly traded corporations. They are private companies, and so those shares would not be held, not be traded on the open market in the same way that publicly traded companies are. Again, I want you to make sure you read in the textbook about limited liability. Again, one of the advantages of the corporate form of organization, that yes, when you invest in a company, buy their stock, you can lose money, but your losses are limited to the amount of your investment. So if the company goes bankrupt, nobody's coming after you for your own personal assets. So when the company sells stock to the open or on the open market to the public, though that creates an ownership class, if you will. Those are the stockholders. They ultimately are in charge of the company, but the stockholders do not generally directly run the company. Instead, they use their shares of stock to vote for the board of directors. So it's one share, one vote. If you have 1 million shares of stock in the company, you have 1 million votes toward that board of directors. The board of directors is then the governing body of that organization. They determine the major direction of the company. They make decisions about hiring and firing those top managers, the CEO, CFO. They hire those officers of the company, and those officers are then responsible for the operations of the company. So it's kind of, even though the stockholders vote on the board of directors, the board of directors then sets major policy for the company. The board of directors is still not directly involved in the running of the company. So again, another layer of separation between the owners and the people running the company. Most of what is on this exhibit is something we talked about or you read about back at the beginning of the semester when we talked about the corporate form of organization. But certainly, again, you should be reading through that. And if you do have any questions on any of that, I would be happy to talk about it. Most of it is information we've talked about in the past. The one item that appears on this slide that I'm going to talk about is the double taxation of dividends. So one of the disadvantages of the corporate form of organization is that the double taxation of the profits of a company. And so what do we mean by that? Well, sole proprietorships and partnerships are, for tax purposes, what's known as a pass-through entity. So a partnership does not pay taxes for the partnership. Instead, the income of the partnership is divided among the partners of that company, and they pay tax on that partnership income as individual taxpayers. The corporation, though, is a separate legal entity. It actually is, in the eyes of the law, it is a person. It can own property, it can sue and be sued, and it can make money. And since it can make money, of course, it is subject to income tax. We talked about this, at least mentioned it in a recent chapter. So corporations do pay income tax, and then with their after-tax profits, they may choose to pay dividends. And that's one of the topics that we're going to be covering in this chapter. So when dividends are paid out, they're paid out of after-tax money, those earnings of the company have already been taxed. And then they're paid out to the shareholders and they are taxed again. So if you receive dividends as a shareholder in a company, those dividends are going to be subject to income tax. Now, they are not taxed as ordinary income. You don't pay Social Security and Medicare on those dividends. They're not earned income in the same way that your wages or salary, your W-2 income would be. And they are actually tax advantaged in that they are taxed currently at a lower rate than your ordinary income. So if you are in one of the lower income tax brackets, is possible under current law that those dividends may not be subject to income tax. If you are in a mid to high income tax bracket, those dividends are going to be taxed, but they are taxed at a lower rate. They're actually taxed at the same rate as long-term capital gains are taxed as well. So there is a bit of an incentive for lower income people to invest, to save for their future, because those earnings are taxed at a lower rate or possibly not at all. But the point is, the double taxation of dividends, the earnings of the company are taxed at the company level, then those after-tax earnings are distributed. If they are distributed in the form of dividends, they are taxed again by the recipient or at the recipient level, the owner level. And that is not true of income or profits from other forms of business organization. And so that's a disadvantage. We talked about in chapter 10, when we talked about payroll and payroll taxes, I mentioned that there were a small number of states that do not have state income tax. I just wanted to show you this. You don't have to memorize, of course, any of these, but you'll notice a concentration of corporations that incorporate in the state of Delaware, in particular banks. I don't see a lot of banks on, or don't see any banks on this list, but major banks tend to incorporate in Delaware. If you ever drive through Delaware, it's a tiny little state, but it's like there's a bank headquarters on every other corner, it feels like. And the reason that they incorporate there is because they can, and it's cheaper. Delaware is a very business-friendly state. They do not have a corporate income tax, just like they don't have a personal income tax. And so it's a good place to do business. And that's why you see so many of them on this list. Now, if you were starting a business here in Western New York, you don't get to just decide you're going to incorporate in Delaware to avoid the taxes. If you only have a physical footprint in one state, that's going to be the state that needs to control or dictate the legal terms of your business. So you would be required to incorporate in the state of New York if you were doing business almost exclusively in the state of New York. So as we start a company, and most companies do not start out as publicly traded companies who would buy that stock when you've never even heard of the company before. Most companies do business for quite some time and establish themselves and then decide to go public. And so they get permission to go public. They have to pay some fees, usually to the attorneys, of course, and the investment firm that's going to handle the sale of that stock, just like we talked about in chapter 11, maybe needing to pay an investment firm to handle the sale of our bonds. One of the advantages of the corporate form of organization is a potentially unlimited life, but it is potentially unlimited. Most businesses don't last forever. And so if we think about the matching principle, it would make sense that if we had to pay money up front for those startup costs and expenses, it would make sense based on the matching principle that we could spread those startup costs over the estimated useful life of our company, just like we do with depreciation for long-term assets. But in reality, we don't know when our company starts. We have no idea how long that company is going to live. And so we can't wait to find out. And just like with research and development, any startup expenses are required to be expensed at the startup of that corporation. So even though the matching principle would make us make it think it might make sense to spread those out over some period of time, in reality, we are not permitted to do that because we don't have any idea upfront what that period of time would be. So we're going to be, if we organize as a corporation, a publicly traded corporation, we are going to sell our shares to the public on the open market. The first time we sell shares, that is known as an IPO or initial public offering. Let me skip ahead here for a second. So I have some room here to write on my screen. So the first time the stock is sold to the open or to the public, that is known as the initial public offering or IPO. There can only be one IPO because initial means the first, like your initial is the first letter of your name, right? So the initial public offering is the first time that this company stock was sold to the investing public. Now, before we can sell that stock, as I said, we need to get permission from the state in which we're incorporating. We need to get permission to sell this stock on the open market. And in order to do that, we have to request permission to sell a certain number of shares. And we'll see some of these terms on the next slide, but as long as I have this white space, I'm going to make use of it. So when we get permission to go public, to sell our stock to the investing public, we have an authorization to sell a certain number of shares. So there's an authorized number of shares. That's typically going to be a very, very, very large number. If you look at the company that you chose for the annual report project, if you look at their balance sheet, you will see information about how many shares they are authorized to sell. And my guess is it will be in the hundreds of millions, if not in the billions or higher. It is a very, very large number for the companies that we're talking about, the very large, well-known companies. So we get permission to sell a certain number of shares. That is our authorization. We are then going to sell some number of those shares when we do our IPO or initial public offering. And we then need to report separately the number of those authorized shares that have actually been issued. So the number of shares that we have issued cannot be larger than the number of shares that we are authorized to sell. So the authorization is going to be greater than or equal to the number of shares that we issue. I mentioned as we were looking at the learning objectives that sometimes a company might actually buy back some of their stock that they have sold. When we buy that stock back, we refer to that as treasury stock. We'll be talking about that a little bit more later. But if we have treasury stock, then the number of shares issued is going to be greater than the number of shares outstanding. So outstanding shares can be the same number as the issued shares or less than. And if there's a difference between the number of shares that are issued and the number of shares that are outstanding, the difference between those two numbers would be the number of treasury shares that we have. So treasury shares are shares that were issued. They're still considered issued, but they're no longer outstanding. That is, they're not out in the hands of the investing public. The company has repurchased them, has them back. Again, we'll talk about why a company might want to do that when we get to the treasury shares topic. So as I said, normally that number of authorized shares is a very, very high number. The company gets permission to sell more shares than they actually plan to sell right away. The rest of them, I think of it as they keep them kind of on the shelf in the back room so that later on, when they have need for more capital, more money, more investment capital, they already have permission to sell more shares, and so they can kind of pull them off the shelf and put them out on the market. As I already said, the first time they sell those shares, it's the initial public offering, but any subsequent offering of new shares is referred to as a seasoned offering. A seasoned offering. When the company itself is selling stock on the open market, we call that a primary transaction, or we say that's the primary market. When the company itself is selling to the public. The vast majority of the transactions that happen on any given day, virtually all of them are transactions happening on the secondary market. God bless you. The secondary market. And so that means that, God bless you. So someone in the investing public, someone owns shares in ABC company, and they have decided for some reason that they no longer wish to own those shares. Maybe it's because the price is high enough that it seems pretty attractive. They're interested in selling and locking in that profit. And so if I own stock in ABC company and I don't want them anymore, I can sell them, and maybe someone else wants to buy them. We usually handle that exchange through an intermediary, through some kind of a broker arrangement. So I would call up my broker. I'm not responsible for, going on Facebook and saying, hey, by the way, I have some stock in, ABC company I want to sell. No, I would just call my broker and say, I don't want that stock anymore. Go ahead and sell it, or sell it when it hits this price. And then through another broker, they handle that transaction. So somebody wants to buy the stock that I'm selling. Okay, so those are called secondary transactions, or transactions on the secondary market, because the company's not even involved in that. It's two private citizens, if you will, engaging in commerce. I have something I want to sell. You want to buy it. We agree on a price. The deal is done. And that is why corporations have a potentially unlimited life, because even if I'm a major shareholder in ABC company, if I die, my heirs will then become that major shareholder. And if I don't want those shares anymore, I can sell them. It doesn't really impact the company. It doesn't impact their financial statements at all. When we look at the equity section of the balance sheet for any company, and we see the section called contributed capital, and that's the section that's going to include the common stock that we've known about since chapter 2. If the company has preferred stock, and that's something else we're going to talk about here in a moment, the company might also have preferred stock that they can sell. When we look at the dollar amounts that represent the contributed capital on our balance sheet, that's the dollar amounts that were contributed when the primary market transactions occurred. So these two types of transactions right here, an IPO or a seasoned offering, represents the amount in that contributed capital account, that contributed capital section. It's how much was spent to acquire those shares directly from the public. And then the market price of that stock is going to continue to change, go up, we hope, go up and maybe come down over time. Those fluctuations in the open market do not directly impact the company itself. It definitely does not show up in their financial statements. Any questions? Lots of terminology here, lots of explanation. Any questions so far? Okay. Okay, so I talked about authorized, issued, and outstanding, so we're good with that. And you should understand that relationship. These circles are a little bit misleading because in reality, they could be all the same size. That is, if we're authorized to sell 1,000 shares, it may be that we have actually sold 1,000 shares. And so that's the issued number. And they could all still be outstanding. So the outstanding circle could be as large as the issued circle, which could be as large as the authorized circle. But based on the relationship I had put on the screen, it's a greater than or equal to relationship. So authorized is greater than or equal to issued, which is greater than or equal to outstanding. Some states require that a stock have a par value. The par value is the minimum legal capital that the company is required to report for each share of stock. The par value is the minimum legal capital that they are required to report. And some states do not require a par value, but might require instead a stated value. For our purposes in this classroom, we're not going to get too worried about or too caught up in the differences between those terms. I'm not sure I could do justice to explaining the difference between them, frankly. From an accounting standpoint, from what we are doing, the terms mean the same thing, which is the minimum legal capital that the company is required to report for each share of stock that has been issued. If you look at the company that you chose for your annual report project, if you look at their balance sheet, on their balance sheet, you're going to see information about whether there is a par or stated value for that stock and what it is. You're also going to see the number of authorized, issued, and outstanding shares. Companies are required to disclose that information. And so for most companies, it's right on their balance sheet. As I already mentioned, common stock comes with it voting rights, 1 share, 1 vote. And the voting shares are going to vote on the board of directors. They might also vote on some other major company issues, but normally the biggest purpose, the biggest advantage that common stock has is voting on that board of directors. So all corporations have common stock. There are even separate classes of common stock. Again, for this class, we don't need to worry about that. Some companies, in addition to common stock, have another class of stock called preferred stock. So if it's preferred, that tells you that it is given favoritism, if you will, in at least one area related to the company. So what is preferred about preferred stock? Well, preferred stock does not come with voting rights. So the preferred stock does not have a vote toward that board of directors. Could the same people own common stock and preferred stock? Sure. But the preferred stock doesn't have voting rights. So what does it have that gives it preference? Why would you want to buy preferred stock rather than common stock potentially? Well, it has preference in receiving dividends. So we're going to be talking about dividend policy here. And if a company declares dividends, the first amounts that they declare go to the preferred stockholders. And then if there's anything left over, the common stockholders get that. Sometimes common stock is referred to as the residual equity. They get whatever's left over, which could be a lot, or it could be nothing at all. The common stockholders are bottom of the totem pole as far as receiving dividends, for sure. If the company was going through a liquidation, if it was, being sold off and we're paying off all of our obligations, in a perfect world, we would take all of the proceeds, the assets of the company, and we would pay off all the liabilities. So liabilities have preference over stockholders, period. And then once all the liabilities are taken care of, then we pay off the stockholders. And the stockholders have the preferred stockholders have preference. So they would get paid first. And again, if there's anything left of the assets of the company, then the common stockholders would share in those proceeds. So preferred stock has preference. They don't get to vote, but they do receive their dividends first. And if the company's going out of business, they would receive their investment back first before the common stockholders. Preferred stock kind of looks like a bond in one respect. That is, they have a stated dividend rate. So preferred stock is going to have a par value, and the dividend rate is expressed as a percent generally of that par value. And so in any given year, if the board of directors declares dividends, they're going to pay the preferred stockholders the stated dividend that preferred stockholders are expecting. God bless you. And then if there's anything left, it goes to the common stockholders. So it looks kind of like a bond in that it has a stated dividend rate. Common stock definitely does not have a stated dividend rate. Whatever dividends are declared, if there's preferred stock, they get paid first and the common stockholders get whatever's left, which may be a lot more than what the preferred stockholders get, at least as a percentage. So if you are an investor and you buy stock in a company, there are two ways that you can earn a return on that investment. So as we've discussed before, why are you investing in a company? Because you want to make money. So how do you make that money? Well, one way is through the receipt of dividends. And what's the other way? If you own stock in a company, how else can you make money? Yes, you might be paid dividends, but what else might happen? What else do we hope happens? How do you make money? By investing in the stock of a company. Anybody? How do you make money investing in the stock of a company? What do you think? Okay, and so what happens? The price of the stock goes up, right? So you pay $25 when you buy it, and now the price is $27 or $28. That is called a gain. And there are two different types of gain. There are unrealized and realized gains. So when do you realize the gain? The gains remain unrealized as the price is going up as long as you hold on to that stock. It's called unrealized because until you sell that stock, you haven't locked in that gain, right? The price could still come back down. Right now, the market's off about 6% year to date. So on average, the average investment is worth 6% less now than it was at the beginning of the year. Some are up, most are down. That gain or loss is unrealized until you actually sell the stock, and now it is a realized gain or a realized loss. By the way, under current tax law, you don't pay tax on the gain until it's realized, until you sell the stock. And if you sell stock at a loss, that is, you sell it for less than you paid for it, you can't write off that loss until you actually sell the stock. Because again, if it's unrealized gain or loss, it could change. Many investors right now are really hoping the market picks back up by the end of the year, right? And so they don't end the year with the losses that are in place right now. That remains to be seen. You may have heard some discussion last year in the discussion of the potential changes to tax law that they were trying to actually write into law that they could tax the unrealized gains or losses. And you can imagine how complicated that would be if we had to keep track of each year in our portfolio, how much gains and losses that are not realized. Because again, the prices of that stock continue to change. That did not happen. That is not part of current tax law, but it is definitely something they've been talking about. Okay. So let's go to our first exercise. That's enough for me talking at least for a minute. And just like we did with bonds, we're going to start with the beginning of the life cycle of the stock. So a company, Jefferson County Rocks Incorporated, it's a marble contractor, and they go public. They sell, with permission from the state, they sell 230,000 shares of $20 par value common stock, and they sell it at $25. So let's start with that. They had to get permission from the state, and they got permission to sell a certain number of shares. Again, that's their authorized number of shares. It could be 1 million, it could be 10 million for this company. I don't know. We're not told in this exercise because it's not relevant for this exercise, but it is important to know that they have permission already to sell those shares. And so when they sell those shares, 230,000 shares at $25, 230,000 times $25 per share, they receive in cash from their new owners, 5,750,000. Sorry, hang on. That's not where I meant to put that. $5,750,000 they receive in cash from their new owners. Who bought those shares? I don't know. My guess is probably people who already maybe work for the company, run the company, bought some of those shares. They may want to keep a controlling interest in the company, possibly. Maybe the CEO or the founder of the company is the recipient of some of those shares, possibly. So that cash part's pretty simple, right? We know since chapter 2, we've known if we receive cash, we need to debit the cash account for exactly the amount of cash that we received. There are probably some fees that we had to pay our investment bank that handled this sale for us, and we would have just deducted those from the cash we actually received. Thank you, Ashton. It's the credit side that is changed or is dependent on whether there's a par value for this stock. If we were told that there was no par value, there was no stated value, the credit side would just be a credit to common stock for that same value. That's if there was no par or stated value. But since there is a par value for this company, $20 per share, $20 per share times 230,000 shares is 4,600,000. Common stock account must always have in it. Put this on the screen for us. The common stock account must always have in it, if there is a par or stated value, it must have that par or stated value for each issued share. So when we issue a share, we are required to put that par or stated value into the common stock account. And the term I used a few minutes ago was, it's the minimum legal capital that the company is required to report. It has to go into that common stock account. And then whatever's left. So if we take the full sale price, 5,750,000, and we subtract the par value from that, we get $1,150,000. That's the amount we need to balance this transaction, right? We want our debits and credits to be equal. That's how much we need to balance that transaction. And that is called paid in capital in excess of par, or sometimes you might see it called additional paid in capital. They had to report that the par value was $20 per share. Anything over and above that is additional or excess paid in capital. I really do want you to look at the balance sheet for the company that you chose for your project. Most of you will see that the par value for your companies is very, very low, maybe a penny, maybe fractions of a penny. It's normally a very small number. There is no intent that the par value represent the actual value of those shares, not at all. For preferred stock, it is it's mostly the value of those shares. And for the same reason that bond prices fluctuate around the par value or the face value of the bond, preferred stock prices may fluctuate around the par value of those preferred stock shares as well. But for common stock, that par value is essentially meaningless in terms of the dollar amount. It's not meant to be the fair market value or anything close to that. Okay, so there's our entry for the sale of that common stock. Any questions about that? Okay. A company may also have preferred stock. We've talked about that for a few minutes already. This company also has permission to sell some preferred stock. Just like with bonds, to sell preferred stock, you have to state the par value, you have to state the dividend or dividend rate. And so when we sell this preferred stock, 12,000 shares, it has an $8 par value, but we sold it for $14. I'm going to say that's a little bit unusual, but it helps us to do our exercise. And so when we sell that 12,000 shares, we sold it for $14 a share. That's $168,000 in cash that the company realized from that. And just like with the common stock, we're going to split that $14 that we realized from each share sale. We're going to split it between the par value of $8 per share times 12,000 shares and the excess, the other $6. We sold it for 14. The first 8 has to be in that preferred stock account. The other 6 is in the paid in capital in excess of par or additional paid in capital. And again, you'll notice that we have this labeled for the preferred stock. And when we report this on our balance sheet, we're going to report the preferred stock above the common stock. So most companies are going to have preferred stock and then additional paid in capital for the preferred stock and that total. Then we show the common stock and the additional paid in capital and that total. And that's our contributed capital. And that's our answer, or that's our question here for part B. If this was an initial public offering, that is, they didn't have any contributed capital prior to these two transactions, what is their total paid in capital as of February 27th? So we have the $5,750,000 from the common stock sale, plus the $168,000 from the preferred stock. And on this company's balance sheet, if we were to look at their balance sheet right now with no other transactions, we would show cash on the debit side of about $6 million and contributed capital on the credit side of about $6 million. Okay, any questions about recording the issuance of stock? Again, if there's a par stated value, it needs to go into that common stock or preferred stock account. And if there's a par stated value, anything over that goes into the additional paid in capital account. Next exercise says Professional Products Incorporated, a wholesaler of office products, was organized on February 5th of the current year with an authorization of 50,000 shares of preferred 2% stock with a $60 par value and 1 million shares of $8 par value common stock. So at this point, they haven't sold any, but that's how much they are authorized to sell. The following selected transactions were completed during the first year of operations. So the first thing they did on February 5th was issue 600,000 of the 1 million shares that they were authorized to sell. So when they issue those shares, they're going to receive cash for that. It says we sold them at par. Now, I've already mentioned that that's not meant to be a market value. And so this is not terribly realistic, not at all realistic, really, that we would have sold them at par, but it does make the accounting easier. So we sold 600,000 shares at $8 per share, a total of 4,800,000. And because that is the par value, the entire amount is going to go into the common stock account. Just like I explained in the first exercise. So now this company has a bunch of cash on the debit side and the asset side of their balance sheet and a bunch of contributed capital on the equity side. Now, as I said, this organization of our company doesn't happen for free. And so we could have taken some of that $4.8 million that we just generated through the sale of stock and paid the attorney's fees. But in this case, the attorney agreed to accept some stock in payment of his fees. Well, why would anyone do that? Because they believe in our company, because they think that our company is going to be worth more in the future than it is now, that there's going to be some growth, there's some appreciation of that stock value. And so that attorney says, I will do this service for you in exchange for stock. And if I want, sometime down the road, I can sell the stock and hopefully make more from that sale. And so when we issue any shares of stock, we know that anytime we issue shares of stock, we have to put the par value of those shares into the common stock account. That's the definition I gave you. In the common stock account, we must have the number of issued shares. In this case, it's 1,400 more times the par value. Total of $11,200 is going to go into that common stock account. We now have more capital, contributed capital on our balance sheet. But we didn't sell them for cash. Instead, we exchanged them for the services provided by that attorney. And I've already explained that those upfront or startup or organizational expenses by rule are expensed at the beginning of the life of the corporation, because we don't know how long the corporation is going to last. So now the company still has almost $5 million, but they plan to use that $5 million for other operational expenses to get our company up and running. And at the same time, we need to acquire some fixed or long-term assets. And so on April 9th, we bought some land, buildings, and equipment. And we bought them through issuing shares of stock. So we issued 60,000 shares of stock. I'm going to jump around a little bit here in what I'm doing. When we issue those shares of stock, we know that for each of those 60,000 shares of stock, we have to put the par value, which was $8 per share. We must report $8 per share as the minimum legal capital in that common stock account. $8 per share times the 60,000 new shares that we issued. Now, if this stock had what's known as, I'm going to put a couple more terms on the screen here, a liquid market compared to what's known as an exotic market. So a liquid market for the stock means that the stock is traded on a regular basis. And so if there is a liquid market for the stock, we can easily establish the market value of those shares of stock. If you want to know right now what a share of Microsoft or share of Apple or Nike or whatever, if you want to know how much it's going for right now, the market's open. You could look on Yahoo Finance or literally any other, business related website and find out what the most recent trading price was. Those are updated, on the fly throughout the trading day. We could find out what that stock is worth immediately. But this company's brand new. And if it's not actively traded, we know that there are, how many shares did we sell up front? Can't remember. However many shares we sold at the beginning, we know that those shares are out there, but they may not be traded actively. It might be that those shares were purchased by the founder of the company and his immediate family. I don't know. We know that the attorney has some shares, but again, we think that the attorney probably took the shares because the attorney thinks the price is going to go up in the future. Probably not interested in selling right now. Even if he did, that's a pretty small number of shares, so only 1,400. So my suggestion is for this exercise, there isn't a liquid market for the stock. We can't just go online and look up what's the current price, what's the fair market value right now. And so the only other objective way we have right now in April of valuing these shares of stock that aren't being actively traded is by looking at what did we get for those shares of stock? And we got land and some buildings and some equipment. And so it stands to reason if we have objective values for that land, building, and equipment, and we do because it tells us this is their fair market price. Where did those numbers come from? Well, we had someone appraise them, right? So we found out that the land is worth $200,000, the building's $310,000, and the equipment is $80,000. We had someone who was knowledgeable and expert in the field of, appraising property. May not have been the same person for the land, buildings, and equipment. Those may have been done by different people. That's fine. But we have reason to believe that those are the objective, verifiable values of those three long-term assets. I just added those together, and the total value of those three things is $590,000. So it stands to reason that we can put these assets on our balance sheet worth $590,000 because we have appraisals, we have hard data to show us that that's what they're worth. We also know that this transaction isn't in balance right now because we have $590,000 on the debit side and only $480,000 on the credit side. We are short $110,000 on the credit side. And so what are we going to call that? It's the additional paid-in capital. Whoever sold us those land, buildings, and equipment were willing to accept stock in exchange for them, again, it's just common sense. They wouldn't have accepted stock that was worth less than the value of what they were putting into the company, right? And so we're going to match those up. And the rule says if there's a par or stated value, that's how much has to go in the common stock account. And anything over and above that is going to be additional paid in capital. Everybody okay with that transaction? So our final transaction then happened on Flag Day, June 14th. We issued 32,000 shares of preferred stock at $82. So going back up here to the information about our preferred stock, we had authorization to sell 50,000 shares, and each share had a $60 par value. So we had authorization to sell 50,000, but we didn't actually sell all 50,000. We sold 32,000. When we sold them, we got cash for them, 32,000 shares. We received $82 per share. And just like with the common stock sale, when there is a par or stated value, that's the amount that needs to go into the preferred stock account. 32,000 shares at the $60 par value. And the rest is going to go in the paid in capital in excess of par for the preferred stock. And so now we know how to record the issuance of stock for cash, for assets other than cash, for the organizational expenses, we know how to record those. And we know how to record the sale of preferred stock and common stock at par or at a price higher than par. Any questions about that exercise? Or about recording stock or par value or anything else at this point? All right, let's keep going then. So now that stock is outstanding and we know that, as we already said earlier in class, there are two different ways that companies can, that investors can make money by investing in a company. And one of those is that the price on the open market, the price of that stock goes up. We see stock price appreciation, it goes up. But that, as I already said, doesn't affect the company's financial records. We don't have to report any of that in our company's books. The only stock-related transactions that affect our company's books are the stock transactions in which we are involved, in which we play a party. So we're selling our stock for the first time, or as we'll see eventually, as we repurchase some of our own stock potentially. The other way you make money is through the receipt of dividends. And if you were listening carefully when I talked about the board of directors, one of the duties of the board of directors is to decide when, whether, and how much to pay in dividends. Some companies never pay dividends, and some investors don't want to receive dividends. So if you're an investor, why would you not want to receive dividends? We already pointed out that dividends are taxable to the recipient. So if you receive dividends, you have to pay tax on them. It's a taxable event. And so some investors may not want to increase their tax liability. Here's another reason that some investors may not want to receive dividends. Let's go back to why you bought that stock in the first place. So why did we say an investor would buy stock in a company? Why would you do that? Why does anyone buy stock in a company? Why would you buy stock in a company? One reason. Why would you buy stock in a company? You want to make money, right? Everyone agree with that? Why would you? It's the only reason you'd buy stock in a company. You might buy stock in one company over another because you just like that company better. You like what they sell. You like the way they do business, whatever. But in general, you buy stock for one reason, and that's to make money. Okay, so you decided to take your hard-earned money and invest it with a company because you think they're going to take your dollars that you invest and turn it into more dollars for you, right? They're going to use it wisely. So if that's your rationale for buying stock in a company, that you want them to take your money and turn it into more money for you, why would you want them to give it back to you in the form of dividends? And the answer for some investors is, well, I don't. I want you to just keep it and make me more money with my money. And so listening to this, you might think, okay, well, if they pay you dividends, then just turn around and buy more stock with it. And there are ways that, there are plans known as DRIPs. So I'm going to put that on the screen here. A DRIP is a dividend dividend reinvestment plan. And so, normally if you're going to buy stock in a company, you have to buy a nice whole number of shares. So you buy 1 or 2 or 7 or 14,000. You can't buy a half share. If the share price is $100 and you only have 50, you can't just buy a half share. But in a dividend reinvestment plan or a DRIP, you can buy fractional shares. And so you can tell the company, if they offer this as an option, you can tell the company, just take my dividends and put them right back in and buy me more shares of that stock. The problem is, even though you didn't receive those dividends, even though you told the company just keep them, you still have to pay taxes on them. And in tax lingo, we would say you were in constructive receipt of those dividends. In other words, you could have received them. You may have chosen not to, but they were still paid out to you. And so it's still a taxable event. And that means that you have less money to reinvest in the company because now, remember, it's been taxed twice. So some companies don't pay dividends. Some investors don't want to receive dividends. We have ways of analyzing dividend policy based on what percentage of the share price is paid out. It's called dividends yield. What percentage of the share price of the stock is paid out as dividends on an annual basis. And again, for some investors, they're looking for a 0 dividend yield. They don't want dividends. And some companies don't ever pay dividends, and that's okay. It's up to the board of directors. When you buy stock, you would probably want to know, are they in the habit of paying dividends? Do they have a history of paying dividends? How much do they pay? So it is up to the board of directors to decide when, whether, and how much to pay as dividends. And what we're going to be doing in this next exercise is looking at the 3 important dates related to dividend policy. So 3 dates related to dividend policy. The first date is the declaration date. And on the declaration date, the board of directors meets and says, yes, we are going to pay a dividend. We are going to pay this much on this date. They declared a dividend. At the time that they declare that dividend, it becomes a liability of the company. As I said, no company is required to ever pay dividends. But once the board of directors says, we're going to pay a dividend, it is now a liability of the company. And on that date, we need to report on our financial statements that we have a liability to pay that dividend. And you can see in this exercise, it tells us they're going to pay a $1,525,000 dividend. And so on the declaration date, on the date the board of directors declares we're paying a dividend, it needs to get into their books as a liability. And the debit side of that is the cost of the dividend. You'll notice that does not say cash dividend expense. It is not an expense in the way we know that term in accounting. Because in chapter 1, we learned that an expense was something that helped us to generate revenues. What kind of speakers are those? What brand is that? Is that a separate brand, or is it Nike, or what is it? He has his own brand now. Okay. So I have no idea if that's publicly traded, so I don't want to use those. I can't see. Sam, what kind of sneakers are you wearing? Okay, I don't know. Okay, you're wearing Nike socks. I'm just going to go with that because I know Nike's publicly traded. So Nike meets and declares their board of directors declares a dividend. You as a Nike consumer, does that impact your decision to buy Nike sneakers or Nike socks the next time around that you need some socks? You're going to be more likely to buy Nike socks because, hey, they paid a dividend last quarter or whatever. Do you even know that? Sam, you're wearing their product. Do you know if they pay dividends? Do you know that they do? No. Does it impact your decision to buy those socks when you were at the store buying the socks? Did you think, ooh, I'm going to buy Nike instead of Adidas because Nike pays a dividend? No. This is very tongue-in-cheek. I don't think anyone decides their purchasing behavior based on, does that company pay a dividend? It doesn't help us make any money. It is not an expense because it doesn't help us to generate revenues. And based on what we already talked about with the double taxation of corporate profits, we know that they're not even tax deductible. So if you look at a company's income statement, you are never, ever going to see a line on their income statement, no matter how much detail you can see, that says dividend expense, because they don't get to deduct them from their income. They have to calculate their income, pay tax on that, and then with their after-tax income, God bless you, decide you're going to pay dividends with that. So this cash dividends is not an expense. It doesn't hit their income statement. It does come out of their retained earnings, though. So it's a cost. It's a cash flow, or will be, but it's not an expense in the way we know that term in accounting. Okay. So on the date that they declare the dividend, the board of directors meets and declares that dividend, it becomes a legal liability of the company, and we need to report that. Now, at some point in the future, and it might be a couple weeks, it might be a couple months, I don't know, there's a second important date, and it's referred to as the date of record, or the record date. And on that record date, there's no accounting entry required. It's an important date, but there's no accounting entry required. So following the directions that are given in this exercise, I'm just going to put in there on August 31st, which in this exercise is the date of record. So that's like 7 weeks later or something. There's no accounting entry, but this is a significant date because it determines who is going to receive that dividend. The stockholder who owns the stock, the owner of record, on August 31st is going to receive those dividends. And so there's a lag between the declaration and the date of record Because if you don't want the dividends, you heard, hey, Nike declared a dividend, I own Nike stock, I don't want the dividend, I could sell my stock. As long as I can find a buyer who wants to pay me what I want for it. I can sell my stock sometime between July 9th and August 31st. As long as I no longer own it on August 31st, I'm not going to receive the dividend. If I still own it on August 31st, I'm going to receive the dividend, even if I sell it on September 1st. And the person who buys it from me on September 1st is not going to receive the dividend. And we would say as of the screen, so as of September 1st, in this exercise, the stock would be trading what we call X dividend, or without the dividend. So if this is a 25-cent per share dividend, and I don't know because it just tells us the whole dollar amount, it doesn't tell us a per share amount. I don't know how many shares this company has outstanding. By the way, we only pay dividends on the outstanding shares. We only pay dividends on the shares that are still in the hands of the investing public. If they've never been issued, we don't pay dividends on those. Who would we pay them to? Ourselves, right? If those shares had been issued, but the company bought them back, they're no longer outstanding, we don't pay dividends on those shares again either. So if this is a, let's say, 25-cent per share dividend on September 1st, when trading opens, in a perfect world, the shares would open on September 1st worth 25 cents less than they were worth on August 31st. Why? Because the 25-cent dividend is going to go to the person who owned it on August 31st, not to the person who owns it on September 1st. And so it's not worth as much. Now we go to the, any questions at this point? There's the first two dates. Everybody okay with those? Okay, so now a few more weeks goes by and we come to the third of the three important dates, and that's the payment date. And you can imagine what that means. We're actually going to pay out the dividend. And so these are cash dividends. We're going to use cash to pay them. And we are going to remove that liability. So back on the declaration date, we set up that liability. We showed on our balance sheet, hey, we owe our stockholders $1.5 million in dividends. Now on October 1st, we're going to mail out the checks and take that liability off our balance sheet because we just paid it. And so those are the three important dates when it comes to dividend policy. If the board of directors never meets and declares dividends, there's no liability, no obligation to pay them. Even if they have paid dividends every year for 50 years, they don't have to pay them this year. No obligation. Am I saying that's a good idea? No, it definitely sends a negative signal to the market. Investors like consistency. They like to know that if you pay dividends every year for 50 years, that you're paying them again this year. It's not a good sign if you don't, but there's no legal obligation to do that. Okay. I'm going to go back to the PowerPoint just for a minute. So in that exercise we just finished with the 3 dates, I'm not even sure if the exercise said, but we didn't talk about whether it was preferred or common stock. And for those 3 dates, it doesn't matter. Those 3 dates are the same function: declaration, date of record, payment date, regardless of whether we're paying preferred dividends, common stock dividends, or both. Preferred stock, we've already talked about that preferred stock has preference in at least 2 areas, and they include the receipt of dividends. So if the board of directors declares a dividend and the company has preferred stock, the first portion of those dividends, whatever they declared, goes to pay the preferred stockholders based on their stated dividend rate. And then if there's anything left over, it goes to the common stockholders. But this slide introduces a new concept, which is the idea that preferred stock may be cumulative. So if something is cumulative, what does that mean? It keeps adding up, right? So cumulative preferred stock, and the other option, of course, is that it's not cumulative or non-cumulative stock, preferred stock. This does not apply to common stock at all. So if we talk about cumulative preferred stock, it means that the dividends keep adding up. If years go by, if any years go by, that the board of directors does not declare a dividend, the preferred stock dividends carry forward. They're not a liability of the company. Remember, we just did the 3 important dates, and the first one is the declaration date. Doesn't become a liability of the company, doesn't show up on their balance sheet until the dividend is declared. But if they have cumulative preferred stock and they do not declare a dividend, they still have to report that it's not really owing. So I don't want to use that term, but they have an obligation, not a liability, doesn't show up on the balance sheet, but they have an obligation to report that, hey, we have cumulative stock and we didn't pay them any dividends this year. And so next year, if we pay dividends, we have to pay off those other dividends last year first. We call those dividends in arrears, and they would have to be all caught up before the company could pay any dividends to the common stockholders. They have to disclose this. It would be in the notes to their financial statements if they had dividends in arrears. Again, no such thing as dividends in arrears on common stock. If the preferred stock is not cumulative, no such thing as dividends in arrears. If the preferred stock is cumulative and they didn't pay all the dividends, they have to report that. And you'd want to know that. If you were thinking of buying common stock in a company, you'd really want to know that they haven't paid their preferred stockholders for 4 years. And by the way, they have cumulative preferred stock. So if and when they ever get around to paying dividends, it's going to be a long time before the common stockholders get anything, because they have to pay off all those dividends in arrears to their preferred stockholders first. And so that's what we're going to be looking at in our next exercise, is the concept of how do we calculate dividends? How do we split them between the preferred and common stockholders? And what if they're cumulative and there aren't enough dividends paid to cover that obligation to the preferred stockholders? And I had to make this, I had to make this a little bit smaller to make it fit all on the screen. So hopefully you can still read that on your own screen. 72 Inc., a developer of radiology equipment, has stock outstanding as follows. 80,000 shares of cumulative preferred 2% stock with a $50 par value, and 200,000 shares of $10 par common stock. So we don't know how many shares they're authorized to sell. We don't know how many shares they have issued. And that's fine, because we're talking about dividends here. Those are numbers that the company has to report. They have to disclose that. How many shares are they authorized? How many shares are issued? And how many shares are outstanding? But for dividends, we only need to know how many shares are outstanding. So we know that the preferred shares are cumulative, and we can see both the dividend rate of 2% and the par value. And so the dividend that we would pay to our preferred stockholders is 2% of the $50 par value. So the preferred dividend is $1 per year. But only if the company pays dividends. Only if they declare those dividends. Everybody okay with where that came from though? $1 a year. You'll notice there is no stated dividend rate on the common stock. There's no such thing. The common stockholders get whatever's left. And it might be a little bit, it might be a lot, but they get whatever's left. So if there are 80,000 shares of preferred stock outstanding and the dividend is $1 a year, in a year that they pay dividends, the first $80,000 goes to pay the preferred stockholders. And if they have dividends in arrears from years that they didn't pay all of that, then even more than 80,000 is going to go to the preferred shareholders. So let's see what happened. During its first 4 years of operations, the following amounts were distributed as dividends. In the first year, they paid $60,000 in dividends. So at the end of the first year, so year one, year end, this is in their financial statements. That's not a word. Year end. Remember, the full value of the preferred stock dividend is $80,000, right? $1 per share times 80,000 shares, but they didn't pay $80,000 the first year. Why did they not? Because they're a brand new company. They didn't have enough cash. That's the one restriction. So a board of directors does not ever have to declare dividends. There's no legal obligation to pay dividends, period. But the board of directors can't declare a cash dividend if they do not have the cash available to pay it. And so maybe in this first year, they didn't pay the full amount of the dividend because they're a brand new company and they just didn't have the money or didn't have the money that they wanted to spend on dividends. Again, maybe they wanted to keep it inside the company and help to grow the company. And so in year one, the full $60,000 that was paid goes to the preferred stockholders and the common stockholders get nothing. And in the notes to their financial statements, they say, we still owe our preferred stockholders $20,000 in dividends in arrears. It's not a legal liability, doesn't show up on the balance sheet, but next year, if they pay dividends, the first $20,000 is going to pay off last year's dividends in arrears. Everybody okay with year one, how it works? Yes, sir. Oh, thank you. It does say, very good. Thank you. Glad somebody's paying attention. So it does say dividends per share. So in year one, they paid 60,000. And that was for 80,000 shares, which would be 75 cents per share. Thank you for catching that. And so that's what we should have. That's what you should have in your table here is 75 cents per share. Thank you. Glad I didn't get all the way through that with the wrong numbers in there, especially because we're running out of time. In year two, they declared and paid $110,000. So the first 20,000 pays off last year's dividends in arrears. The next 80,000 covers their obligation for this year. I know it's got to be per share. I'm just going to put that number in there as a placeholder. So they pay the 20,000 from last year, dividends and arrears. Then they pay the next 80,000, then they've completely met their obligation to the preferred stockholders. They paid a total of 110,000. So that means the last 10,000 went to the common stockholders. And so in year two, at year end, they have no dividends in arrears. And the 100,000 that was split evenly among the 80,000 preferred stock shares is 125 per share. And the other 10,000 went to the 200,000. Whoops. Okay. $1.25 for the preferred stockholders and 5 cents for the common stockholders. Make sense? Okay, with the last couple minutes we have here. The third year they paid 100,000 in dividends. They have no dividends in arrears. So how much did they pay to the preferred stockholders? Didn't have any dividends in arrears, so they would pay the exact amount that they're obligated, $1 per share. That calculation's at the top of the screen. It's a total of $80,000. And how much is left for the common shareholders? If they paid 100,000 in total and 80,000 went to the preferred stockholders, 20,000 went to the common stockholders, shared evenly, 20,000 divided by 200,000 is 10 cents per share. And in year 4, they still pay 80,000 to the preferred stockholders. That leaves 40,000 for the common stockholders. 40,000 divided by 200,000 is 20 cents per share. So why, when you look at this, why would anyone buy common stock? Instead of preferred stock? What do you think? Why would anyone buy the common stock? Say that again. Okay, so we can see a positive trend here, right? Well, the common stock also, the preferred stock probably costs around $50 a share. The common stock probably costs nothing like $50 a share. The dividend keeps going up on the common stock, but we know if dividends, even if dividends increase, even if in year 5 they pay 200,000 in dividends, how much does the preferred stockholder get? Just $1. The preferred stockholder is safer, it's less risky, because if they pay dividends, they're going to get their $1 a year. But there's a limit on the upside. That's really all they can make is the $1 per year in dividends. And the price of that preferred stock is going to stick right around that $50 mark, because why would someone pay $100 when you're still going to get the same $1 a year in dividends? So it acts as a cap, a limit on the upside, where there is no limit on the price appreciation on that common stock. It can and will, if the company's doing well, continue to go up and up and up. Dividends aren't the only way you make money on the stock, as we already pointed out. Okay, so we'll stop there for today. On Thursday, we will finish up chapter 12. Don't forget, if you are able to join us tomorrow morning for that review session, please sign up in Starfish. Thanks for being here, everybody.